Thanks so much for tuning into Talking Point. I'm your host, Niraj Shah. The markets have flattened out today, and until the Fed outcome is out of the way, very likely we'll see that kind of behavior. But the case for a chat today for our guest, well, the usual suspects, right? We'll naturally talk about whether the ministerial portfolios will have a market impact or no, or a specific sectoral impact or no. Will FPIs wait for clarity before they come in? Or is the clarity enough now for foreign flows to come in, as we saw in some bits in Friday's session? And are there green shoots for consumption pickup as the market toggles between guesstimating whether some bit of the capex push will slow down from the government's end and rural recovery will also gain focus or no? We pose all of those questions and more to Gautam Trivedi, co-founder and managing partner at Nepean Capital, joins us right now on the show. Gautam, great having you as always. Thanks for taking the time out. Hope all is well.
All's good. I just got back from the US and I wanted to share also some of the feedback that I got by meeting asset allocators, fund managers, etc. So happy to.
Let's do that because the last time that you were here, or not the last time, but a few times ago you were here, you gave us a very interesting insight about US inflation. Now give us the insight on what are asset managers saying.
Yeah. As far as your first point is concerned, as far as US inflation is concerned, that's still raging very, very high. So frankly, I'm not surprised if the Fed, continues to pause on any rate cuts until they actually get inflation under control. So, but getting back on the feedback front, so I think the average institutional investor that I've met still remains very positive on India from a long-term growth perspective. So that hasn't changed at all. Notwithstanding, of course, I was there before the election results. And I don't think things would have materially changed post the election results, only because of the fact that everybody that I met wanted to see Prime Minister Modi back for a third term. So that event actually has actually now happened. The second part is the reluctance to incrementally add more money to India at this point of time. I think it's a sheer valuation, which I don't blame them, because we're now at 21 times calendar 25 PE versus 9 times for, let's say, China. So if you've seen the money flow this year to date, as in from 1st of Jan till now, versus the whole of last year. Last year, India was highest in the pecking order, ex-Japan, wherein we took in a net FPI flows of $21 billion. This year, we're a negative 4.3 billion so far. And we're actually lowest in the pecking order. So if I include Japan, the pecking order now is a net positive 33 billion of inflows into Japan. Korea, surprisingly, is taken as much as 16 billion. China is 12.2, Taiwan is 6, and we are a negative 4.3. So I think it's gone a full circle. Now, what are the questions that I did ask all of the people that I met? I said, India's historically been expensive, and especially over the last 3 years, it's always traded at a huge premium to China, over 100%. In fact, in between, it actually went as high as 160%. So I said, what's changed? Why is it that you guys are shunning India now and putting money in other markets? What they said specifically on China, they said that besides the fact that the market's very cheap, they said the Chinese government has announced a slew of measures to improve and stimulate the economy and also the property market. So in some sense, that incremental money that may have come to India has all gone into China, and that's over $12 billion, as I said. So I think that's some of the feedback that I've got. But I think I'm sure a lot of them are happy that the Prime Minister Modi and his cabinet is back. We haven't seen, of course, who's going to get what portfolio, but we'll discuss that a little later. But point I'm trying to make is that economic and policy continuity is very much there, and that's, I think, resounds very well with foreign investors.
Gautam, to your sense, a two-part question rolled into one. The fact that the new cabinet has a significantly, or not a significantly, but a lower number of ally ministers than what was earlier believed by the market or the media, as the case may be, right? So does it mean that a higher probability of policy continuity? We'll know in a few hours, but one portion of that. And if that is the case, does it augur well? Part one of my question is that. Part two, on the flows piece that you mentioned, because you mentioned that incremental flows have already gone into China to a certain extent, right? Yeah. Do you reckon by your conversation that that's the pattern that might continue? Because China is still very cheap relative to India even now?
No, that's a fair point. I think the point really is that the valuation, which was not an issue until December, has now suddenly come back to haunt us. So because there are alternatives. I mean, not just China, but even look at Korea. Korea has taken in $16 billion year to date. So that's a gigantic number. So my point is that I don't see foreign institution investors coming back in a hurry. They're very pleased with India. When you look at their total holding in India of $900 billion, mark to market, I think as of last week. So if you look at that number, selling 4.2, $4.3 billion is really not that big a number. So I don't think we should be concerned about the fact that foreign investors may be uncomfortable. I think they're comfortable. It's just the absolute valuation is now become an issue because they have a choice. When they didn't have a choice, India was fine. Now that they have a choice, India is looking expensive.
Okay. So what happens from here on over the course of the next 6 to 12 odd months, Gautam? Do Indian markets kind of stay range bound because there is a continuation of policy, but it's an expensive market? Or do you believe the street will be, as you said, enthused by this, and we may continue to stay in the expensive zone and move higher from where we are right now as earnings trickle in and as the market gets closer to maybe even FY26?
So, here's the point with respect to earnings. Let me address that first. I think on an earnings perspective, nobody doubts India's, still probably the best, from an earnings perspective, the best large economy in the world. GDP wise, we're still the best performing for the last 3 years and will continue hopefully for the next several years in terms of absolute GDP growth. Having said that, if you look at the earnings growth consensus earnings growth estimated for India and China, they're pretty much in the same ballpark for the current financial year, i.e. 14 to 15%. So earnings growth in other markets also need to be considered before, being happy about what we're doing in our home country. So that's one. Second is, I think a lot's going to depend on, I don't think it's so much to do with portfolio allocation. I mean, if somebody else allocated, a certain ministry, I don't think that's necessarily going to impact the market as much as the fact that what is going to happen with respect to domestic flows. And will the domestic flows continue at the same pace that they've been, which is about 20,000 crores or so in SIPs? Of course, that's a gross number. It's not a net number. But the fact is, this market is being propped up in terms of valuation, as we all know, by domestic flows. And I don't mean just the money coming into mutual funds, but also money coming in directly from family offices, AIFs, PMSs, etc. So if you look at the collective domestic flows, it's beyond that 20,000 crores. I don't have a number to it, but that's a much larger number. So the point I'm trying to make is that will the government, and there's a lot of fraud, as we all know, in the F&O market, will the government and the SEBI take steps to control that fraud? And if that happens, you will see a correction. Frankly, a correction in the market would be actually very good news for a lot of fund managers, including myself. So if that were to happen and there's a pullback, I think incrementally you'll see more money coming in. I think the central point which the government needs to address, and as does the SEBI, is that we've seen in the last 3 years a whole new class of investors entering the Indian equity markets. We've seen the financialization of savings in a very massive way, right? But the new investors who've come to the equity markets for the first ever time, either they're investing through their mobile phones or their laptops, which is incrementally 90% of the way people are investing. They can't get burnt. These are new investors. I think we have to make sure they don't get burnt and don't lose a lot of money, because some of these people will then never ever come back. You want the equity culture in India to spread, not contract again. So I think my view is that if the government takes certain steps to rein in the exuberance which is there in the F&O market, and of course that would immediately impact the cash market, would be actually good in the long term.
Gautam, with the belief that something like that could happen, or whatever else, are you doing any major tweaks to your portfolios in the period between now and the budget, or would you do all of that only once the budget measures are out?
The budget's probably about 3.5 to 4 weeks away is what I hear, assuming it's in the first week of July. So it's not that far away. I think there have been a lot of research, sell-side research reports coming out saying that go easy on some of the sectors that have outperformed, whether it's some of the government companies, defense, railways, which have really done very well, multi-baggers as well. So and there's talk of getting into underperforming sectors. So pharma will do well now, as will FMCG if the government now starts to focus and create more rural opportunities and rural income opportunities, should I say. So I think there's chatter around that, but I don't think anybody has a handle as yet. Even when I today talk to people on the ground who are either with FMCG companies or in the consumer facing companies, there is no significant pickup as yet. So we'll have to wait and watch to see between now and the budget, or even after the budget. I mean, budget's not the only time to do this, but what are the steps the government does take to alleviate the rural consumption? So it's a wait and watch, frankly.
Would you preempt, and therefore would rural focused themes come back in portfolios in a meaningful way? Because we saw FMCG gain a little fits and starts and then came off as well. We were speaking to Bajaj Auto just before we started talking to you, and they were hopeful of some more upticks in the times to come from the domestic, let alone exports. Is the weightage of rural focused themes slightly more than what it was, Gautam, in your portfolio?
It's all changed literally in the last few days since the election results. And that's the reason we've seen a lot of these rural plays spike. Mahindra, of course, has gone through the roof, hit a new 52-week high last Friday. It's a great company. I'm just giving an example of how some of these stocks are doing. So I think the market has started to preempt some of those actions that the government could potentially take. But honestly, I think it's a wait and watch. And frankly, if you miss the first 10%, doesn't mean there's more juice not left in some of these stocks. So I'd rather wait and watch and see what steps the government takes.
I mean, as is the case with every election outcome, some of the some linkage stocks tend to do very well. We saw this whole focus on what the TDP could do in infrastructure in Andhra, leading to some of those stocks do well. But I just wonder if indeed the capex push and the infra push continues, not just in Andhra, but the rest of the country as well. What about some of the commodity names which are ancillaries, cement, steel, etc.? Do you think they come into flavor?
I think your theme about capex plays will continue. Whether you like it or not, the government has been for the past few years and will, I think, continue at least for the next couple of years to be the big spender in the economy. Private sector capex outside of the top 10 large industrial groups, we don't really hear that much. A lot of the companies that we've been talking to over the past 12 months have been more focused on reducing debt. So if you look at the loan books for most of the private sector banks or even the public sector banks, we haven't seen that big a pickup as yet on the corporate side. So my view is that the capex burden still continues to fall on the government of India and the state governments. So that theme will not necessarily change. As far as cement is concerned, my concern really is the absolute supply that's coming in and the inability of the cement companies to have any major pricing power. So in the absence of that, you still may get I suspect, 7 to 8% or maybe even a 10% growth in the stocks. 10% seems unlikely, but more high single-digit growth in the stocks, but nothing that's going to give you a big burst that you've seen over the past 3 years.
All right. Where is it that you are most confident of? Because I come to you with the knowledge of how you've said that your feedback suggests that there is money flow that has happened to China. It may not be necessarily over. We're still a month away from the budget and some policies could come in as well, which might impact portfolios. Where are you most overweight at the current point of time, Gautam?
So we are a special situations fund, so we're not necessarily overweight a certain sector, and we don't approach it from that standpoint. We look for the incremental change or the catalyst that's not today priced into the stock. Things like change in ownership, change in the CEO, new management coming in, bringing in their whole new team, any sort of change at the corporate level, deleveraging, M&A, IPO. So those are the things that we look for. Also, generational change, a big event for us. So our strategy is actually quite different from the average fund that is, looking at growth or doing sector rotation. So we're not really in that game. So like I said at the beginning, that I think sectors that have underperformed, chemicals again, big one. I'm not saying it's a buy. All I'm saying is that it's time probably to relook at some of these sectors which have been underperforming and are cheaper than the rest of the market.
Point well noted. Would banking fall under that view? Because I heard you say that corporates are deleveraging, so therefore, if the balance sheets are healthy, they may not necessarily resort to very large bank credit, if you will, but they can figure it out to do it in that fashion. And I mean, I don't know if banking also, if there are special situations out there, but even if they are not, do you have a view on banking by and large?
No, I do. I think banks, private sector banks would be, if you do need to put money, I think private sector banks are starting to look very attractive. Who would have thought HDFC Bank would be trading at 2.1, 2.2 times price to book forward? And I think the PSUs have had a great run, but I think the valuation gap between PSUs and privates may still continue for a while. So it may be time to start dipping into the private sector banks because of the sheer valuation, but I don't expect spectacular results. Of course, there's been chatter about MSCI-led changes that will bring in a lot of money in certain banks. That is a technical reason. That's not necessarily so much fundamental. But if that were to happen, that would be very positive for certain banks in the private sector.
Okay. Okay. Gautam, last question, and that is on information technology. Now, a bit of a conundrum people have because of the whole AI thing, not linked to the government at all. And the opinion is divided right down the middle. More bears than bulls, though. Are you, which camp are you in?
I'm in the camp where we thought the Indian IT companies would find a way out of the situation that they're in right now, and it's not really that so much their fault. But the fact is, if you've got a third of the IIT batch which hasn't got offers, that clearly tells you how tough things are. And the IITs are not just the best in India, but best among the best in the world in terms of engineering talent that graduates every year. So there is clearly a problem with IT services, and whether it's AI or whether it's something else that's going to change the fortunes of Indian IT companies, we don't know. I think it's way too early. The Infosys CEO, Salil Parekh, did allude to AI being a great opportunity, but I don't know if it's early days or how will they reposition themselves. I think historically, Indian IT companies have done a great job of reinventing themselves when times are tough. They did great with Y2K, if you remember back in the day. But can they pull something off? I don't know. I'm not qualified to answer the question, and I'm just going by guidance of what I read in the papers by some of these CEOs. But I think Indian IT should make a comeback. When that happens and what course it'll take, it's too early to tell.
Yeah, well, maybe that's the most fair answer, Gautam, because I don't think too many people know really what's happening out there. But thanks for taking the time out today. Great having you. And well, we look forward to the posts as they come in, but really appreciate your time, Gautam.
You're welcome. Thank you. Bye-bye.
All right. And that's the view from Gautam Trivedi of Nepean Capital. And that's all the time that we have on this leg of Talking Point. Thanks so much for tuning in.